Well, this past year saw our dollar reach parity, of course, with the U.S. dollar and beyond. But what's in store for the high-flying loonie next year? And will 2008 be a year to buy, invest, or save? Joining me now with his financial forecast for 2008 is TD Bank Chief Economist Don Drummond. Thanks for coming. I guess it's always a year to save, though. You always want to save a little bit.
And Canadians don't do very much of that.
And we don't do much of it.
Zero on balance.
Well, tell me about, in terms of the loonie, where it has gone, where you see it going.
Well, of course, it was a wild ride in 2007, touched $1.10, the all-time high. It was really a commodity play. I would say there was a fair bit of speculation when it took off to that all-time high, but commodity prices have virtually doubled in the last couple of years, and the dollar went up with it. We've seen commodity prices flatten out recently, and we've seen the dollar come down a bit. For 2008, I expect that with a slower world growth led by some slowdown in the United States, we'll see commodity prices, particularly oil, pull back a bit, not a lot, but a bit, and see the dollar sink down further. So we're looking for it to be about 94 cents U.S. at the end of 2008 and to about 90 cents U.S. by the end of 2009. So still high from an historical level, but certainly off the recent peaks.
But a little more reasonable for manufacturing as well.
If most manufacturers probably have about 80 to 85% of the productivity of the U.S. counterpart, so any dollar stronger than that's going to be tough for them, but yeah, a lot easier to deal with 90 cents. And they're responding, they're bulking up on machinery equipment, they're becoming more effective. So I think that most of them could get by with a profit margin at 90 cents.
Yeah, because most of the machines, particularly business machines or for businesses, are coming from the States.
This is the silver lining of the dollar. We import 70% of our machine equipment. I think that's the #1 reason why we're less productive in the U.S. We just don't have as much capital to work with. This is a golden opportunity to bulk up on that machine equipment. Businesses were slow off the mark, but we've seen in the last couple of quarters they really have been ramping up their investment.
So the dollar hovers in around 90, 95, as you said, in the new year. Then we get another break, another 1% drop in the GST. So does that mean we should be running out to the store and buying things?
Well, it's interesting because we're conditioned to think that the strong dollar is bad, but it's here. Let's enjoy it because there are some benefits. We talked about machinery equipment, but we import a lot of consumer goods as well. For example, automobiles. And we have seen the prices of automobiles. They usually jump up in October with a new model year, and a whole bunch of the models, they came down. We're increasingly seeing the Canadian dealers offer actually the exact same prices in the U.S. or at least getting closer to the prices in the U.S. So the prices on a lot of things have come down from what they were in 2007. So a good opportunity there. Of course, Canadians, particularly in the winter, like to travel outside Canada, and the stronger Canadian dollar helps going a long way on that front as well.
So that's all good news. What about if you are going to make, say, a car purchase or a truck purchase? Is there, a better deal, import, North American, anything in that line?
It doesn't really matter in the sense that there's so many imports into Canada. Even if it's domestically produced, they really have to be competitive with the imports. So you're really seeing the price breaks increasingly coming right across the board. Even Rolls-Royce now is priced in Canada the same as the United States. So what are we waiting for?
You run out and get that Rolls. What about real estate?
Well, there's the great divide between Canada and the United States. Thank goodness on our part. We're seeing free fall in some of the U.S. housing markets, and we're seeing continuing strength in Canada. In eastern Canada, we've seen the price increases settle into the mid-single-digit rate. Still some pretty hot markets in the west. But
yeah, we were talking about 70% price in St. John's, Newfoundland.
Well, and of course, that's offshore oil related. We've seen some of the really hot western markets, like particularly Calgary, cool off, and I think Edmonton and Red Deer and some of those areas are about to cool off. But still, it's very stable in Canada. We don't have that fragile subprime underpinnings. We got a lot of demand for housing. Income growth's pretty good. Interest rates, yeah, they've gone up a bit. Is it a matter of
time, though, before, we keep talking about this credit crunch and all of its effects south of the border. Is it a matter of time, though, before it starts to hit us?
Well, I think it already is, in the sense that demand for our exports has been very weak. The only difficulty hasn't been the exchange rate. There's definitely been a softening of our addressable demand, particularly in the automobile market for the United States, and we supply much of that. So I think we're living those effects, but we're coming through it all right. Manufacturing are struggling, but not doing too badly, and the service sector has been doing quite well. And housing's continue to be a positive. I think it will quieten it down, but I don't think it's going to go into the funk that the U.S. is in.
Okay, Don Drummond, thank you so much for your time.